It is IPO morning, and your thumb is hovering over the buy button. The ticker says SPCX, the headlines say history, and somewhere in your chest, there is a feeling that if you do not get in right now, today, at whatever price the open gives you, you are going to spend the rest of your life telling people you watched the biggest IPO ever from the sidelines. SpaceX is finally going public. The rockets land themselves. The valuation is $1.8 trillion. And every cell in your body is screaming that this one is different. So before your thumb comes down, I want to take you somewhere. Not to a chart and not to a lecture. I want to take you back in time to 3 other mornings that felt exactly like this one. Because here is the thing nobody tells you about IPO day. You have seen this movie before, it just had a different ticker on the poster. My name is ST, and I spend way too much time trying to make sense of the market. If you have ever felt that once-in-a-lifetime pull on an IPO morning, that fear of being the only person who missed it, subscribe and stick around, because today we are going to look at what actually happens to the people who buy the open on the biggest IPOs in history, and the numbers are going to be a lot more useful than the headlines. First stop, May of 2012. The company is Facebook, and at the time, it is the most hyped IPO of a generation. 900 million users, a movie about the founder, and a feeling everywhere that this was obvious, that you would have to be an idiot not to buy it. The offer price was $38. Within about 3 months, the stock was trading near 17. The most obvious company in the world, the one everybody used every single day, cut the people who bought that morning roughly in half by the end of the summer. And here is the detail people forget. Facebook eventually became one of the great stocks of the decade, but the people who bought the hype that first morning had to sit through a year underwater first, and most of them did not make it. They sold somewhere in the dark, at a loss, on the most obvious company on earth. Next stop, spring of 2019. 2 IPO mornings, Lyft and Uber, the apps sitting on your home screen, the companies that changed how an entire generation moves around a city. Lyft priced at $72. It basically never saw that price again. Within a year, it had lost more than half its value. Uber priced at $45, dropped on its very first day, and spent the better part of the next year below its offer price. 2 companies you used every weekend. 2 products that genuinely changed the world. And the people who bought the open on day 1 spent years waiting just to get their own money back. Last stop, November of 2021, and this one is the cleanest warning label ever printed. Rivian, the electric truck company, priced its IPO at $78. The stock opened above 106. Within a week, it touched roughly 170. And for a moment, this company, which at the time had delivered only a tiny handful of trucks, was worth more than Ford and General Motors combined. Sit with that sentence, more than Ford and GM combined, on almost no revenue. You know how this ends. Over the next couple of years, Rivian fell more than 90% from that peak. The trucks were real, the factory was real, the product was genuinely good. And the people who bought that first week still lost almost everything because the price they paid had already spent the next decade of good news in advance. 3 different years, 3 beloved companies. 1 identical movie. So the question stops being whether SpaceX is a great company, because Facebook was a great company, and Uber changed the world, and Rivian builds a genuinely great truck. The question becomes, why does this exact same thing keep happening to the people who buy IPO morning? And for that, there is real research with real numbers, and it has been sitting in finance journals for over 30 years. A professor named Jay Ritter, the guy academics literally call Mr. IPO, published the landmark study back in 1991. He tracked what happened to investors who bought IPOs at the closing price of the first trading day and held on for 3 years. On average, they underperformed similar existing companies by roughly 29%. Not because the companies were frauds, most of them were real businesses with real products. The buyers underperformed because of when they bought and what they paid. And his updated data, running all the way through recent years, keeps finding the same shape. Measured from that first day close, the average IPO lags the market over the next 1 to 3 years, And the worst performers of all are the ones that went public in the loudest, most crowded, most exciting years, the years that felt exactly like this one. Now, here is the mechanism, because once you see it, the whole pattern stops being mysterious. There are two completely different prices on IPO day, and almost nobody on your side of the screen ever gets the good one. There is the offer price, the famous number in the headlines, the price the banks sell shares at the night before trading begins. And then there is the price you can actually buy at the opening trade the next morning. Historically, the average IPO pops around 18% on day one. That pop is the part everyone remembers, the part that makes IPOs feel like free money, but that 18% does not go to you. It goes to the institutions and insiders who were allocated shares at the offer price the night before. By the time the stock opens and your order fills, the free money part of the trade is already over. You are not early, you are the person the early people are selling to. The pop is not your profit. The pop is your entry fee. And then there is the part of the calendar almost no first-time IPO buyer has ever heard of, the lockup. When a company goes public, the insiders, the employees, the early investors, the people holding the really cheap shares are typically banned from selling for about 180 days, 6 months, which means 6 months after the confetti, a wall of supply gets unlocked, held by people whose cost basis is a tiny fraction of yours, people who have waited years for this exact moment to cash out. Mark that date on any IPO you ever watch, because the calendar itself is quietly working against the morning buyer. Now, let me say the honest part, because on this channel, we do not do villains where there are none. Nobody is hiding any of this from you. The risks are printed by law in a document called the prospectus, and SpaceX filed one with the SEC like everybody else. It says in plain text that the company has been losing billions of dollars. It says that Starlink, the satellite internet business, is the only part of the company that actually makes money, roughly 2/3 of total revenue. The rockets you love watching land themselves are, financially speaking, not the product. The internet subscription is. None of this is a secret. It is just printed in a 200-page document in calm legal language, 3 links deep, while the headline about the $1.8 trillion valuation is printed everywhere you look. The information is not hidden. It is just quieter than the hype, and the hype is doing all the talking. And to be completely fair, I have to give you the other side of the data too, because it matters here. Ritter's research also shows that the terrible long-run numbers are driven mostly by the small, unprofitable, story stock IPOs. The really big companies, the ones with serious revenue, on average roughly track the market after they go public. They do not collapse on average, and they do not outperform on average either. They just become normal stocks. So no, the data does not say SpaceX is doomed. SpaceX is real. The revenue is real, $18.7 billion of it. What the data says is something quieter and maybe more deflating. Even in the best case, the most likely outcome of buying a giant IPO at the open is that you paid a once-in-a-lifetime feeling for a roughly average stock. I can already hear the objection because I have felt it myself. But ST, this is SpaceX. This is not some scooter startup. This is the company that catches rockets out of the sky with chopsticks. And you are right, but notice what you are actually arguing. You are arguing the company is extraordinary, and I agree. That was never the question. Facebook was extraordinary. Uber was extraordinary. The question is whether the price is extraordinary too, because at $1.8 trillion, you are not buying SpaceX as it exists today. You are buying SpaceX after the market has already priced in Mars, priced in Starship flying daily, priced in Starlink on every roof on the planet. A great company and a great stock are two different things, and IPO morning is the single moment in a company's life when the gap between those two things is at its absolute widest, because the price was set at the top of a 6-month marketing campaign designed to make it as high as possible. One more detail from this specific deal, and I will just hand you the fact and let you think about it. SpaceX is reportedly setting aside up to 30% of its IPO shares for retail investors, ordinary people, through trading apps. The typical IPO sets aside 5 to 10%, 3 times the normal allocation in the largest listing in history. Maybe that is generosity, a chance for regular people to finally get the offer price instead of the open. Maybe. But there is an older rule on Wall Street that has survived every cycle, and it goes like this. Ask why you, specifically, are being offered such a generous seat at the table. When the smartest sellers in the world triple the amount of inventory pointed at the public, the least you owe yourself is one quiet moment of asking what they know about the price that you do not. Now, because this deal is actually offering regular people the offer price through their trading apps, I owe you one more distinction because it changes the math and almost nobody will explain it to you. Getting allocated shares at the offer price the night before is a completely different trade than buying the open the next morning. The offer price buyer is the one who historically collects that 18% average pop. The open buyer is the one who historically pays it. Same company, same morning, two totally different trades. So if your app offers you an allocation at the offer price, that is genuinely the better seat in the room. But before you celebrate, you need to know about the oldest trap in the IPO business, and it has a wonderful name, the winner's curse. Here is how it works. When a deal is truly hot, when every institution on earth is fighting for shares, allocations get cut to crumbs, and you, the small buyer, receive almost nothing. When a deal is weak, when the smart money quietly passes, suddenly there are plenty of shares for everyone, and your full order gets filled with a smile. Read that again, because it is one of the most uncomfortable truths in finance. The amount of shares you are given is itself information. You win the full allocation most easily in exactly the deals you should want least. So if the biggest IPO in history fills your entire retail order without blinking, that is not necessarily a gift. Sometimes the easiest ticket to get is the one for the show nobody else wanted to see. So let us come back to IPO morning, to your thumb hovering over the buy button. Here is what I want you to take from the time machine. Nothing about this morning is new. The certainty you feel, the fear of missing the future, the sense that this one is different. The buyers of Facebook felt it at $38. The buyers of Lyft felt it at $72. The buyers of Rivian felt it at $170, worth more than Ford and GM combined. The companies were real every single time. The feeling was real every single time. And the price was wrong every single time. Because IPO morning prices are not set by what a company is worth. They are set by what a 6-month marketing campaign can convince the most excited person on the planet to pay, and on that particular morning, the most excited person on the planet is holding your phone. SpaceX will probably keep landing rockets either way. The only thing being decided on IPO morning is what you paid for your seat, and history is brutally clear about who pays the most. The people who buy the open on the loudest morning of the biggest IPO in the most exciting year. If the company is truly going to the stars, it will still be going there in 6 months, after the lockup, after the first earnings report, after the hype has burned off, and the price has had its first honest conversation with reality. The rocket does not care when you board, the price does. I will see you on the next one.